Okay, so
Captain Highlander got more attractive recently, I think.
he did.
Like,
I
what
find
happened
he
there?
wasn't.
Remember
He was.
that old that guy that used to be
He looked a
this
little
guy?
more weathered back when I was a
Yeah,
kid, but somehow I guess this is his son. Maybe
yeah.
that's likely
You're
the
you're
case.
born looking kind of just
Yeah,
the silver
I
fox look.
yeah, somewhat of an iconic company. I think, at
Yeah.
least for me. I mean, I ate
Hmm.
lots of Highliner food, and they seemed to do a lot of marketing when I was a kid too. So it was a well known brand, but also a publicly traded company, and a company that we actually had coverage on at Keystone several years back. I think we picked up coverage maybe around 2010. And sold it around maybe the 2012, 2013 timeframe. But let's take a look at them today, because they've come out with a couple interesting quarters here that are worth some analysis. What they are, they're a leading North American processor and marketer of frozen seafood products. This is for the retail and food service markets. Food service primarily meaning restaurants. So when I talk about it being an iconic brand, I'm thinking about those breaded frozen fish sticks with the Captain Highliner logo smiling back at you. But they also, most of their business is actually selling into the wholesale market to restaurant and food service. So trades under the symbol HLF at about 1650 right now. It's a 500 million market cap company, just below, and it also pays a nice yield of just over 4%. So when we take a look at the company's recent performance, we can see a pretty nice bump here from November of last year. Stock moving up after the company released its Q3 2024 results. Now, these results were a little bit mixed, so it's interesting to see how the market responded to them. So revenue was actually down 12% in the third quarter, but adjusted EPS up 43%. So we're going to look at that in a few seconds here in relation to the recently reported fourth quarter. Now, if we look longer term, if we go way back, this company's been around for a while as a public company, much longer even just as an operating business. But really, it's been a wild ride for shareholders. As I'd said, we got out of the company, I believe, around that 2012, 2013 timeframe. So we avoided a lot of this volatility, but it does look like the company has started to perform a little bit better, at least on some metrics recently. So looking at the company, just breaking it down by geography, 78% of the company's sales are to the US, 22% to Canada. And then when you break it down by channel, 32% retail. So that's like you go into your grocery store, you see their products and you buy them at the cashier. 68% food service, which is that wholesale business. So diversified throughout North America, but weighted towards the US. Now, let's take a look at the recent quarter that was released, Q4 2024, and the full year results. Now, if we look at sales for the quarter, they were actually lower, actually, for the quarter and the year. So 235 million in the quarter, down just slightly, really just flat from 237 million. We did see a nice little uptick in gross profit margin, 21.7% in the recent quarter compared to 20.5%. And then adjusted EBITDA, about 8.8% growth to 23.7 million, and a little bit of an uptick in the margin there. But then when we look at adjusted EPS, 41 cents compared to 23 cents. So quite an increase there, almost a double, in spite of adjusted EBITDA only moving up in the single digits. Now, the first thing we're going to look at here is just the weighted average share count. So we can see that it had come down quite a bit, actually, about 10% in the quarter compared to the previous year. So 30 million shares compared to about 33.8 million a year ago. Now, what is the reason for this? Well, these are share buybacks. The company's producing a lot of free cash flow. It needs a place to put that, and it believes that it believed that its own stock was the best investment of that capital. So it purchased shares, canceled them. You're seeing the share count decline, and that is one of the things that's pushing the earnings up. But there are a few other drivers as well to the positive performance on the bottom line there, the differential between adjusted EBITDA and earnings per share. So there was lower depreciation and amortization. That's a non-cash expense, so I won't focus too much on that. But also lower underlying interest expense. So the company has been reducing its debt. It paid out about 21 million in interest for 2024. Which was about 5 million lower than what it paid in the previous year. So it got good uplift from that. And then also those share buybacks, reducing the share count. So this is really a combination of a number of different levers here. You had the positive adjusted EBITDA, you had the improvement in interest expense, and then also the lower share count. Looking at the balance sheet as well, as I said, the company's been reducing its debt. So debt has declined in terms of leverage ratio, about 2.3 times on a net debt to EBITDA basis compared to 2.6 times a year ago. And then based on valuation, it's trading at about 11 times earnings right now, based on that 16.50 share price and adjusted EPS for 2024 of $1.51. Now, there aren't many analysts that are covering the stock, so there's no use of looking at analyst estimates. We're really just looking back at the trailing earnings per share. In terms of what the management's outlook is, they do have a cautiously positive outlook going into 2025. They think that they're going to benefit from volume growth. They also think that they are well positioned to do acquisitions, but there are some headwinds in their market as well that have impacted volumes, and that's why we've seen the lower revenues. So I think that having a fairly conservative or realistic projection in terms of what the growth will be going forward would be wise, and I wouldn't be expecting another 50% plus increase in earnings per share going into 2025. So our take on High Liner Foods, they do appear to offer good value. We like the business. I mean, I actually have a bag of High Liner fish sticks in my freezer right now, and it is very encouraging to see this strong earnings growth. So one of the things that I'm going to say about High Liner here, and this is just really my own speculation, but I really see this as being a company where there's a high potential for it to be bought out or privatized, hopefully at a significant or meaningful premium to their existing shareholders. Why do I say this? Well, one of the reasons is that, it's been around for a while. As I said, it's an iconic brand. I don't think that it's going anywhere. Consistently profitable, but not necessarily well suited for the public markets because it's not a company that produces consistent levels of growth from year to year. So the valuation has been depressed for a while. Right now trading about 11 times earnings, not extremely depressed, but certainly I would still say at a discount relative to its underlying fundamentals. Yet it is a big free cash flow generator, reasonable leverage on the balance sheet, and I just think that that's a mix for somebody wanting to basically take this thing private or acquire it at some time if they are willing to. So it is a family company, so it is largely still owned by the original founding family, I believe. So if there was going to be a privatization transaction, I would imagine it would be them. Again, hopefully that would be at a good premium to the existing shareholders. But really the market, though, in terms of their end markets, they are facing a number of headwinds. As I noted, revenues have not been growing recently. So we are seeing strong earnings growth from some improved margins, lower interest, and then lower share count. But that's not necessarily a sustainable long-term growth strategy. We would like to see some strengthening in the volumes and in the revenues. There's also the potential tariff-related risks with the U.S., specifically High Liner, as I said, 76% of revenue in the U.S., and they produce a lot of their product in China. So it would be primarily the tariffs between China and the U.S. that would impact them. But we do think that the fundamentals are quite strong. So from a value perspective, it does look like a good company long term. We're not ready to go out right now and make any recommendation on it, but we are in the midst of our research for our 2025 Canadian Dividend All-Star Report. Right now, it's up at the top of the list in terms of further research. So that report should be out before too long. I don't have an exact date, but when it is out, there could be a recommendation in there or perhaps not. We'll continue to monitor. All right. Any comments?
Yeah, so I think one of the biggest shifts you did highlight that the leverage going down for net debt to EBITDA, but also just they've previously had, and I think they still do, is primarily floating debt. So just the general interest rate structure for the entire market going down has been helping them as well, which is obviously a great positive for them. Because that was, I believe last time you did a segment, at least for the podcast for them, was that high leverage, I think around 4 times. And that has brought down, the actual payments have brought down. And that's really just been so accretive to their bottom line. And I think previously, when you looked at them before, they were being impaired by that high inflation at the time. So this was a year and a half ago, 2 years
Yeah.
ago now.
Yeah, yeah, and that is one of the things that I've noted about them is that they have in the past had trouble passing on higher costs to their customers. So they don't have the greatest pricing power there. They have been able to pass on some costs at times, but that is often a headwind for them.
Yeah, and it's a good point on the lower, like the floating debt coming down and certainly improving their profitability. For sure. It's certainly a company we monitor.